Good morning, Bookmap. Welcome. Apologies for running late this morning. Daylight savings has completely thrown me off. I forgot to reset the clocks in my apartment. So this morning I thought I had plenty of time, and I did not. I was running late. So once again, my apologies. All right, well, let's jump right in and talk about the markets and what we are seeing here. All right, so let's take a second to just kind of talk about what happened at the end of the week last week. It was kind of a bizarre week for the market, so it's worth taking a second to kind of digest what happened. Several things of importance took place. First and foremost, at the beginning of the week, we broke out of a balance area. Okay, the market had been balancing in this area in here. We broke out of that balance, came back in, rotated to the opposite end of the balance, where we immediately, almost to a tick, found support at the balance area low, turned around, went straight back up through that balance, and then got a breakout. That breakout led to continuation, which is what we would expect, right? If the market had tried to break out the week before last and it failed and it came back down to the opposite end, that tells us that probably the next breakout will work. The next breakout will actually find support and continue higher, which is what it did. We broke out, we got continuation, and then we got continuation at the beginning of the day on Friday when we made a new all-time high and brought in new buyers at the high. But what happened from there? Well, those new buyers got squeezed. So let's just zoom in for a second and we'll take a look at Friday's range. So what happened early on in the morning was the market got what Jim Dalton describes as getting overly long, overly fast, right? The market was going straight up in the A and B period. There was no pullbacks, nothing, just buying and buying and buying and buying and buying and buying. And the problem with that is when people are chasing price like that, there's only so many traders willing to chase price, right? So most traders, the bigger, traders out there are going to buy pullbacks. They're going to buy support. They're not going to chase price at the all-time high. So unfortunately, the majority of the buyers up here in the A, B, and C period were FOMO buyers, right? They were short-term traders that were hopping into a trade as quickly as they could in case the market continued higher. Well, as soon as the market came back through that overnight high, now not only do you squeeze all the overnight traders who are like, oh shit, I got to take profits quick. Not only do you squeeze those traders, but you squeeze all these FOMO buyers. So that led the market to start to liquidate lower. Well, that liquidation brought in new selling, right? Everyone's so nervous when the market is at the all-time high. Everyone's so nervous that the market's going to have some big pullback that they just kept selling and selling and selling and selling. Okay. And at the end of the day on Friday, it could have gone either way, right? There were signals that the market was going to head lower because we had pulled the fairest price to do business lower, but there were also a lot of signals that it was just a pullback that was looking for a bounce because once again, we came back almost to the balance area high, which is a place where the buyers start to step in, and they stepped in. Also, value, that's this blue box that you see right here, was just engulfing the previous day's value. Now, if it had gone just a little bit lower, that would have been bearish to see because it would have been overlapping to lower. But the fact that the value area high stayed at the value area high of the previous day was the signal to be neutral on Friday. Well, then over the weekend, the bulls showed up once again, pushing the market right back up to all-time highs, making new all-time highs once again in the overnight, which means they're weak. So the level that we're looking at right here, 51, we'll call it 96. That is what we consider a weak high, meaning at some point, the regular trading hours market needs to come back and pass through that level. Okay. So you combine that with the fact that, we had the pullback that found support. We had the momentum. We now got the pullback. It just really increases the odds that there are buyers in this market. So this morning, as I'm trying to figure out how I'm going to take trades, there are several things that I'm keeping in mind. One thing that I'm keeping in mind is the contract rollover. Okay, so today is the official rollover day into the M contract. So that means there's always price fluctuations between the contracts. They're usually off by 10 points or whatever, one from another. So that is partially what I'm seeing here, right? Is just moving from one contract to the next created this big move in price to the upside. Okay. The other thing is not everyone rolls over on the first day. Some people wait until the liquidity is larger on one contract than the other. Some people just wait for whatever positions they're in on the previous contract to take profits on those before they roll over, whatever. So over the next 2 days, everyone's got different levels that they're looking at, right? Everyone's got trend lines drawn in slightly different places. They've got candle highs and lows in slightly different places. So I would predict the next 2 days will be a little bit tricky to kind of get exact entries and things like that. So just purely the fact that we have the contract rollover is a reason to be cautious, a reason to be certain that you're buying support or selling resistance before you enter the trade rather than just blindly, throwing in trades. So the area that I'm going to use, even though technically this whole range is the overnight from the weekend, I'm going to just use the profile that you see right here between 51.64 and 51.97. That is going to be the newer contract because my continuous ticker here just automatically rolls over on the new day. So this just automatically is the new contract, the M contract. And that is what I'm going to use as an overnight high and an overnight low. Okay. As always is the case, when the market opens inside the previous day's range, I'm going to assume chop first thing in the morning. I'm going to assume that the market will find support either above this overnight low, or it will just look below and fail if the market wants to continue higher. So if the market pushes below 51.66 and it starts to get new selling there, I would be bearish for a larger pullback towards the fairest price to do business that we left behind on Friday. Okay, so resistance at the overnight low increases the odds. We're heading to the POC from yesterday. If the market looks below and fails, so if it dips below this overnight low, comes back up into the range, I would assume more chop, more sideways. Okay, the same thing with the overnight high, the high at 97. If the market pushes above that and it fails and it pulls back in, I would assume more sideways, more chop. If the market pushes above that overnight high and comes back down and turns it into support, that will be bullish for continuation higher. So I am forced to be very cautious this morning because we're in a chop zone where we are already expecting chop, because the end of the day, the fairest price moved lower, but yet we're opening up at the upper end of the range is another reason for caution, another reason for less certainty one way or the other. And then lastly, the resistance in the overnight range. This is a 45-degree angle from the high to the point of control from the overnight range. That is likely to act as very, very strong resistance. So even if the market wants to make new all-time highs today, even if it wants to get above 97, it's going to take some serious effort to get there. So that means I don't want to go long, for example, on a look below that fails, go long and fall in love with that trade. I want to go ahead and take profits in resistance and look to re-enter, because they may need to just grind and grind and grind and grind today to fight through this 45-degree angle and make those new highs. So if you've been following what I've been saying, it's a lot of contradictory signals, right? There's a lot of contradiction. The week high tells us we're going to make a new all-time high. The 45-degree angle says it's going to be very, very hard and it's going to require a lot of chop, right? The fact that we closed at the lower end of yesterday's range and we had pulled the fairest price down there increases the odds we need to head back down. But the fact that the overnight worked its way all the way back up, even though it's a contract rollover, that doesn't matter to me, is bullish. So we've got bullish signals, we've got bearish signals. So there's just a lot of reason for caution here today. The market is open. We're seeing it as a chop zone. So let's see what happens. We're watching support and resistance levels to see how the market behaves at those. If the market gets smacked down in resistance, we watch the halfback for support. If not, more chop. If it gets support down here near the lows of the overnight low and it comes back up, we watch the halfback for resistance. If not, more chop. It's a chop zone. They're going to chop it up. Chopping broccoli. Chop zone. Oops. Oh, no. So once again, with the contract rollover, you know, things might look a little funky in the Bookmap. They might not look the way you're used to seeing them because the liquidity is very, very different, right? There's still a lot of liquidity on the old contract, and then there's liquidity on the new contract. So with the contracts being split and different traders, you know, entering trades on different contracts, you know, it'll be a little bit harder to read once again using order flow. But this is just the nature of the business. Every 3 months, we got to roll over. And there's a couple of days where things are a little more tricky. All right, let's see who's hanging out. Good morning to Will. Frito is here. I did not remember to move my clocks forward. Bill, good to see you. DNK. Yeah, we'll correct that, the time change on the Bookmap. I'm here. John, email is out now. Laura, good to see you. Danny is here. Cool Beans, good morning, good morning, good morning. Percy in the house. SC. Ships, welcome. He says, our clocks don't change for 3 more weeks. Well, don't forget once the day comes. Cool Bean says, I have no volume. I hope you guys can hear me. The demo trader in the house, John, is here. John says, I thought the end of the contract was on the 15th. Yeah, so this week is the rollover week. You have to be on the new contract by the 15th, but you can choose to switch from trading the one to the other at any time this week. And like I said, every trader sort of has their own reason for doing it. Some people, they say whichever contract has more liquidity, they just automatically start trading that one. Some people, if they're in a trade, for example, a swing trade to take profits at the all-time high, they're going to still be in the older contract waiting to get to the all-time high. For me, because my software automatically rolls over, this contract that you see over here on the left side of the screen in the market profile, that's automatically going to roll on Monday. I just start trading the new contract on Monday because I just want to trade what's on my screen. I'm keeping the old one here on Bookmap just in case I want to poke back and see what's happening, just to see the differences between the two. But my focus is on the M at this point. Okay, so we got some support down here around 51.70. We're looking for a bounce there. It's a chop zone. if not just below that at about 67. If both those levels break and we get below the overnight low, there is a chance to start getting bearish. But in my opinion, the higher probability is a bounce and more chop. Good morning to Groot. Bust a Move, Debbie B. Shame 2005. He says, is the market profile chart part of Bookmap? It is separate. If you just Google, whatever broker you use and then market profile, you'll find out which ones you're able to get access to. It is a separate type of software. So what Bookmap is showing you is the order flow. It's showing you where the liquidity is currently sitting in the order books and how it changes over time. That's what's called the heat map, this sort of dark and bright areas that you see over here on the right side of the screen. And then over here on the left side of the screen, this is market profile, which basically shows you the contracts after they actually trade. So this is showing you where the liquidity is before the market trades. This is showing you where it traded afterward. The volume profile, which are the little sections with the volume, that is showing you where the most contracts traded. The TPOs, that's where the letters are, that is showing you where the market spent the most time. And both are very important to understand because price advertises, so the market moves to a new location, to a new price level. Time regulates, so if it can spend time there, well, then they can do business. Obviously, if it moves to a new level and it instantly pushes away, they can't do business there, right? So the more time the market spends at a certain level, the more likely there is to be two-sided trade. And then volume measures the success or failure of that trade. So if a market moves to a new level and it spends lots of time, but it doesn't bring in volume, well, then it's likely to push away. Whereas if it moves to a new level and it does bring in volume, well, then you've got business being had there. And that's the whole thesis for how I trade the market intraday every day is balance and excess, right? Who's in charge? Are the buyers in charge? Are the sellers in charge? Or are they playing tug of war where one side is trying to beat the other? So this morning, we see it as a chop zone here in the overnight range. That is a form of tug of war. That is a form of buyers and sellers competing with one another. So if the buyers can get the price above the chop zone high and spend time and bring in volume, well, they're likely to keep it going higher. Same thing with the sellers if they get below. They get below and they spend time and they bring in volume, or what we call resistance, right? They're likely to take the market lower. In between the two, they're likely to play tug of war. So the buyers will push it up as high as they can. Then the sellers will come in and push it down as far as they can. And then the buyers, and then the sellers, and then the buyers, and then the sellers. So, for example, something to talk about is we've got this level right here. This is on the older contract, on the H contract, right around 5101, okay? Where there is just a large set of orders sitting in the order books. No matter what the market's been doing, they've just remained there. Often when I see something like this, my assumption is it's a computer, right? This computer has got, and I can't explain what it's doing, right? Don't ask me to explain that, but it's hedging something. Maybe it's hedging something from the options market. Maybe it's hedging a trade in the futures market. Who knows? But there's some sort of hedge that's happening here. There's some sort of mechanism at play. Well, why is that on the old contract and not on the new contract? Well, because probably it has something to do with contracts on the old contract, right? So somebody bought options on the H contract, and the market maker that sold those options is hedging somehow using liquidity, right? This is a much more complicated conversation, but that's why it's there on that contract, but not on the other one. If we click over here and we look at the M contract, there's nothing. So that's what makes these couple of days around the rollover tricky, because people are positioned on both contracts and there's just more games afoot. Good morning to Matt. Chi-Town says, Monday morning party time. Dude, I haven't even made coffee yet. But we'll party soon. Demo Trader says, Charles, can you show us your way of reading open interest in the CME website? I don't really look at that, to be honest with you, but I can take a look. Yeah, so this is just a way to see. Let me get rid of this. This is just a way to see which contract has more volume at that particular time. So right now, the older contract still has more volume on it. So a lot of traders won't roll over to the new contract until that one has more liquidity. So at the moment, there's probably a lot of people still trading the March. But as I said, I always just roll over that first day because my software automatically does. And there's plenty of volume. You know, I'm trading 3 ES contracts at a time. There's plenty of volume for me to get a fill. So that's why I roll over early. Pavel, what's the name of the contract? It's M. So ESM 2024. Cool Bean says, don't forget to smack the like button. Yeah, I forgot to mention that you should smack the like button. Let's get them likes going. Boo, 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 boo. It's Monday morning. We got 135 people hanging out, but only 32 thumbs up for the Pirate. Let's see if we can break 50 here. Heck, let's see if we can break 75 likes. Nothing else happening. Market is just chopping anyway. Chopping broccoli. Shanae says, last question, outside this presentation, where can I learn more about the footprint, such as the significance of the 45-degree angle? Well, again, footprint is different from market profile. They're very, very similar, but they're not exactly the same thing. So as far as the 45-degree angle is concerned, that refers to time. So that's the TPO charts. Where can you learn about it? Brother, you come to the right place. So I've got an e-course available on my website, piratetraders.io. If you just scroll down on the homepage, you'll see it there. That's a great resource. If not, I would recommend Jim Dalton. He's the person I learned from. His courses cost a lot more money, but you can learn straight from the source. There's also tons of books out there like Markets in Profile that have lots of these insights. And of course, the number one recommendation I would make, and technically this is me just plugging my own service, but the Pirate Traders Brigade. I charge $10 a month and I have these conversations all day, every day. So if you hear me talk about the 45-degree angle and then you watch how it plays out that day and you see, oh man, we really did have to just fight and fight and fight and fight and fight to get through there, then you'll understand better because you'll see it in real time. $10 a month for the Pirate Traders Brigade. Okay, so we pushed up into some resistance from that overnight range. Market came back down, found no support at the halfback. So the chop will continue. Once again, we got support around 71 and 67. Looking for more chop. At TV, do we roll over to September since it's a leap year? Solid. Good morning to Nap. 777 in the house. Happy by the effing P day. What's a P? Should be D? Not True says, is there a lecture available? Yeah, I got a e-course that's available on the website. Piratetraders.io. Check it out. Check it out now. Education's your brother right about now. Whoops. Demo Trader says, what is the 45-degree angle? Never heard of it. Curious now. Yeah, so it's a behavior in the market where if the overnight creates a 45-degree angle from the high going down or from the low going up, that is a sign that the high or the low of that overnight will likely hold that next day. It's basically just, imagine again, we're talking about the tug of war between buyers and sellers. Let me just get rid of this. So, the buyers tried to push the market up and the sellers smacked it down, and they tried to push it up and it got smacked down, and they tried to push it up, smack down, smack down, smack down, smack down, smack down. So anybody who was getting short in here, they're very strong sellers, right? They do not want to give up on this position. They do not want to let the market get back above that high. So they will likely keep doing that throughout the regular trading hours. As the market pushes up, they'll smack it down again, and it'll push up and they'll smack it down again. So it doesn't mean that you can't get through it and continue higher. It just means you have a lesser probability of that. And more so than even the probability of getting through, it's the way it would have to get through. It would have to grind and grind and grind, probably spending a few hours to get through there. So if it's from the high of the overnight down, it's resistance. If it's from the low up, it's support. But again, that is based on time, not volume. Okay, so we're down here testing the resistance. Do we get a bounce? If we do, the next level we will watch is the halfback to see if they turn that into resistance. When the market is in a chop zone, it is impossible to know what's going to come next. Your guess is as good as mine, and that's all it is, a coin flip. But the one edge we can have is that if the market pushes down into support and it finds it and it comes back up and then it gets resistance exactly at that halfback, that increases the odds they'll break lower, or vice versa. That's really the only reliable insight we have in a chop zone. Nando says, why is Tesla ripping? Is Tesla ripping? Nah, it's just bouncing. Just a bit of balance. It'll rip if it can get above Friday's high. If it can get, I mean, it's almost there, but if it can get above 82.74 and find new buying, 182.74 and find new buying there, then it'll rip. But for now, that's just balance. Ain't no thing, Jelly Bean. Okay, so they got a bounce in support, but they couldn't get back to half back. That is bearish to see. It increases the odds. We're going to poke below this overnight low. Again, this is just me calling this the overnight low, 51.66. The question then becomes, does the market look below and fail, pulling back up in, or does it look below and get new selling down there at the lows? Let's find out. Okay, market creating a poor low here in the B period increases the odds that we're going to push up, get some resistance, and then take out that overnight low. So we're back to that note of liquidity we talked about earlier on the H contract. Do they spoof it or does it fill? Oh, they're definitely going to spoof that. Nope, they let it fill. Wow, okay. All right, so here's our moment of truth. Again, we're talking, this is a little complicated because we're talking about different contracts, but on the M contract, do they look below 65 and pull back up above, or do we start to get new selling down here? New selling is bearish for further downside continuation. All right, we have new selling below the low. That is bearish to see. That increases the odds the market needs to head lower. Next major support I see is around 51.57. Again, we're here on the M contract. 51.57. Looking for a bounce there. If not, 51.52. And I remain bearish as long as we remain below the halfback right now. So if the market pulls back up into this overnight range up here, and it doesn't get resistance at that halfback, meaning it passes back through, well, then we just got more chop. And the market's probably going to go sideways for hours. I mean, maybe even all day. But if they hold resistance here at the overnight low at 51.65, or they hold resistance at the halfback, 51.72, the higher probability is further downside continuation. That is bearish to see. People always say to me when we've got these contract rollovers where I'm basically looking at the new contract, right here with this profile, but I'm using the old contract over here, Friday's profile, as potential support levels. Obviously, I'm looking at this node right here as support. People say to me, how does that work, Charles? And the answer is, I don't know. Okay? Don't ask me to explain why it works like that, but it does work. So I just always roll over on the day of the rollover, and I just always use old levels from the old contract, and they just work, and don't ask me to explain why. Okay? It is what it is. Jay says, no falling asleep today at the wheel. Laugh out loud. Yeah, today is going to be a tricky day, as we discussed. Exact levels of where the market will reverse will be very, very hard to call. So we just got to kind of be in the flow of the market, recognize changes as they happen, and go with the flow. Probably be this way again tomorrow as well. Will says, does the ESM4 high of 52.57 on Friday mean anything? So for me, no, right? Because I didn't care about the M contract until today, right? That's the thing. So until the official first day of rollover, which is today, that other contract means nothing to me. The information from that contract means nothing to me. I'm just focused on the old contract. Now I'm worried about the new contract. So the overnight high last night, that matters, right? That's important to me. 51.96, the high today, which is our current daily high, 51.8275. That's important to me. But anything prior to that from last week doesn't matter. Seven Mile Reach says that last high on the daily was a little telling. Red candle couldn't reach the top of the channel. Let's see what happens at the bottom of the channel. What are your channel levels? Sheena says, what's the difference between market profile, volume profile, TPO chart, and footprint? So volume profile and TPO charts combined, that's market profile. It's just different words for the same thing. And footprint chart is very similar. It just shows you basically volume profile, but you can create it any way you want. So if you look here, you can see on my Bookmap chart, these little bars right here. Actually, you can hardly see them. There we go. See, now you can see those bars. So the way I'm choosing to organize that information is based on volume, right? And I want each bar, so each one of these that you see, to represent 20,000 contracts. Okay? So we just finished 20,000 contracts. Now they've created the new bar here, right? So you just have complete control with Footprint as to how you want to organize that data. Do you want to use ranges? Do you want to use time intervals? Do you want to use reversals? And you can get really specific about how you organize that information, and you just figure out what works best for you, right? The way volume profile works is it just blatantly shows you where the volume traded. So it's just each level along the vertical horizon, wherever the market traded that amount of volume, it just shows you that exact amount of volume. So they're all kind of showing you the same information. It just lets you organize it slightly differently. In the end, for those of you that are curious, my opinion on it, there is no one right tool to use. And I'm not just saying this because I'm on the Bookmap channel right now, but literally Bookmap is the only thing I've seen that is completely unique. And that's the heat map feature, right? Being able to see where the liquidity was, where the orders that didn't trade, being able to see where that is on the chart is extremely valuable. But Bookmap's the only one I've ever seen that is unique in that way. Every other charting tool that exists on planet Earth is just organizing the same information in different ways, right? Where does the market go? Price. How much time does it spend there? Time. And how much volume does it bring in? Volume. So if you look at, a TPO chart or market profile chart, it's showing us the volume on individual levels. Right? Where did that volume trade? It's showing us the time. We have it set in 30-minute candles, but it compresses it so that we can clearly see where the market spends the most time, right? Whereas if you look at a candlestick chart, it's the exact same information, right? It's just displayed differently. On the candlestick chart, we can see where price went, the candle high and the candle low, right? We can see where the opening and closing was based on the stick part, not the wick. We can see how much volume traded, but we can only see how much volume traded in that time period, not at that particular level. And we can, of course, change the time period to any amount we want. We can do 30-minute candles, but we can't compress them on top of each other to very easily see. So it's every charting thing that exists out there is just showing you the same information, price, time, and volume in different ways. Your job as a trader is to figure out which one works best for your brain. Which one, when you look at it, it makes the most sense to you. There are traders that use nothing but naked candlesticks and literally nothing else, and they make tons of money. There are traders that have 50,000 different things on top of this. They got Bollinger Bands, and they got RSI, and they got MACD, and they got, the VWAP, and they got moving average, and they got all this stuff built on top, and they make a lot of money, right? And there are people that trade with nothing but market profile and make a lot of money. So it's not the tools that matter. It's how good you get at using those tools. So when you're trying to figure out what you want to use in your trading, looking for resistance right now at 51.66. When you're trying to figure out what tools you want to use in your trading, just see what works best for you. What does your brain look at and understand what it's seeing? And then once you've figured that out, just become an expert at that thing. and just spend years and years staring at that chart every day the same way and become an expert at it. This is the way. Okay, so very important here. The market needs to turn either the overnight low, where we currently are at 66, or the halfback, which is just above us at about 70. It needs to turn one of those two into resistance. If not, that was the move for the moment, and we're likely to pull back up and go sideways for a while. So the sellers need to smack the market down right here, right here, right now, right here, right now. Bow, now, 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 now. All right, we have resistance. The bears remain in control. So once again, talking about the M contract, I see some support literally right below the low. So in this node right here, I would say anything above 53, look for a move back up to test that overnight low again. If the market gets below 53, you're looking for a larger pullback down towards yesterday's point of control, which is down at 51.36. So either they bounce here or they take the market lower. As far as beyond 36 goes, we just have to wait and see. My guess is it probably wouldn't go much further than that. It would probably reverse there and we go sideways. But anything's possible, so we'd have to take it one tick at a time. I would say as of now, the bears are in control. So as long as they can continue to stay in control, there's no end to how far down they could push it. Time-wise, in about 5 minutes, we're going to print another TPO. If you're looking at candlesticks, just, another 30-minute candlestick. From that point, from the point that we print the C period, we have to stay below the B period high to keep that momentum going. Okay. And if they take the C period lower and then we print the D, it's the same thing, and so on and so forth. And we will just monitor for continuation to the downside. With that, I'm going to say goodbye to the Bookmap. Thank you all kindly for joining me. Appreciate you. If you like what you see, you might consider joining the Pirate Traders Brigade. Just head on over to piratetraders.io/join. It's $10 a month, and we hang out and talk about the markets all day, every day, or at least for the first hour every day. So we'd love to have you there. If not, we'll see you here next Monday. Thank you very much. Members of the brigade, give me 5 minutes to make some coffee, and then I'll be live. All right, see you guys in a bit. Thanks a lot.